Okay, good morning, ladies and gentlemen. Welcome to MACROACE with your host, Tony. Going to go through the data for Bank of Canada, the sentiments surrounding it, what to expect, and some of the comments that we had received last time round, and also comments from other investment banks and what they expect for the Bank of Canada. So let's get into it then. So first of all, for how does it affect the markets? Well, when we talk about the currency, usually whenever rates go higher than what the market anticipates, then the currency sees upward momentum. It has a more of a bullish reaction. Unless the figure is as expected, then usually you get more of a muted reaction. And particularly if there are no surprises that are presented in the rate statement as well, which again is we're not only looking at the figure, but we're also looking at what the central bank says itself and as to how it came to that decision in the first place, which can have a very big influence, bigger than even the figure itself sometimes. So sometimes you might get, where the central bank might raise rates bigger than expected, but then the statement could be very dovish, i.e. talking about how the economy is not doing as well as they thought it would be. Maybe inflation is coming up faster than they thought. And also with regards to future monetary policy, whether they need to do more tightening or less tightening, depending on what data that they have seen. But usually higher than expected rate hike or a rate decision that's made usually is bullish for the currency market. Then if we carry on to the stock market, similar thing. When the central bank, let's say in this scenario, when the central bank raises rates higher than expected, stock markets take that in a negative way, because of course that means borrowing costs go higher, and that also in turn will lead to those stocks, those companies, making less profit than they would have done if rates were at the same level or if they were cut. So when a rate cut does happen, that will usually lead to a bullish reaction for the stock market, because of course borrowing costs ease and they're able to make more money from that, because customers and consumers have a low rate of interest as well. So then they can start borrowing more money than they would have in the past in order to increase their own spending on the goods and services that they want to. Then for the bond market, whenever rates are raised, usually bond yields will go higher in anticipation of maybe rates staying at a restrictive level or rates potentially going higher in the future as well. And then on the flip side, the bond prices, they see a decline. Of course, that's how the bond market works. When bond yields go higher, bond prices go lower. And when bond yields go lower, bond prices go higher. The reason for that is that a lot of traders and investors, what they'll do if they see that the market is not going in their favor, then what they'll do is they'll jump out of risky assets such as stocks or exotic currencies, or the assets that are not seen as safe havens, and then put their money into safe haven assets like government bonds. And off the back of that, you see the bond yields see a depreciation and bond prices start to go higher. So there's a level of demand, there's a level of supply and demand that is controlled there within the bond market as well. Then where is the economy at the moment? So inflation is at 3.8% compared to 4%. CPI trim, core CPI is at 3.7% compared to 3.9%. GDP quarter on quarter annualized at minus 0.2% versus Q1's 3.1%. Employment change, last time around that we had, it was at 63.8k compared to 39.9k. Average hourly earnings ticked a bit higher to 5.3% compared to 5.2%. Unemployment rate remained unchanged at 5.5%. Retail sales was weaker than before, minus 0.1%. PPI stronger than before as well at 0.6%. The raw material price index at 3.5% compared to 3%. And the IV PMI was at 53.1 compared to 53.5. So if you're looking at the PMI data, any of the PMI datas, the basic rule is a figure above 50 shows that that area of the economy is in expansion. Anything below 50 shows that there is a contraction in that area. And usually what economists say is that a figure of 47.1 or below shows that that area is in recessionary territory and not doing well. Remember, it's a makeup of, how many orders are those purchasing manufacturers receiving or making. What does the business outlook look like for their business? And then from all of that is gathered and then compiled into an index from 0 to 100. And then you get, usually anything 50 or above shows expansion, below 50 shows a contraction in the area. So the previous Bank of Canada rate decision on September 6th, the rate remained unchanged, and the Bank of Canada, what they said was that they see higher CPI in the near term and little downward core momentum. And tightness in the labour market has eased gradually, and they expect CPI to accelerate further due to higher gas prices. International oil prices are higher than what they had assumed in the July monetary policy report. That's something I want to touch on as well, of course, with the Israel-Hamas conflict and how oil has again seen an uplift because of that conflict and the uncertainty surrounding how much longer will the conflict go on for? Will it spread into wider areas, or will other nations start getting more involved? That has caused a concern, of course, for not just only the oil market or the commodities market, but also everyone else who is in the camp of risk on or risk off, deciding, how will one, as said, how long would the conflict go on for? And then two, what are the reactions taken or steps taken by everyone else viewing the conflict? And then how will that then affect the conflict and who will ultimately come out on top, or whether it will be a stalemate, and whether it's going to end. So that's going to be quite important and I think it's going to be another highlight that the Bank of Canada is going to bring up again, is from that uncertainty. Remember, this is the conflict only, the conflict then turned into war, only started on October 7th. So you would still, we would expect some commentary about the Israel-Hamas conflict and how that could spur on higher energy prices. I remember Canada is heavily reliant on their commodity exports for their nation. It's a commodity-based currency that Canada has. So any sort of things that are going on with the commodity market will have a stronger lingering effect on the Canadian economy compared to other economies that are not commodity-based or heavily reliant on exporting their commodities to the international market. The meeting minutes, newly introduced for about half a year now, I think. Meeting minutes from September 20th. What did the members discuss during the monetary policy meeting? During the monetary policy meeting that they had last time, on September 20th, when they released that. So the Governing Council did not want to raise expectations of a near-term reduction in rates at the September 6th announcement. They agreed lack of progress in underlying inflation remained a significant concern, and the Governing Council weighed whether high core inflation could persist, even as evidence accumulated that restrictive monetary policy was slowing demand. Higher prices for oil and gasoline would drive inflation higher over the next few months. And again, as said, the central bank is more very likely to talk about oil prices at this meeting that they've had, rather than not touch on the Israel-Hamas conflict. They may not cite the Israel-Hamas conflict specifically, but the talk of higher energy prices should definitely be a factor within this statement that they released today. So the Bank of Canada survey on October 6th, of a survey of consumers and businesses. I focus more on the businesses side of what they feel where the economy is headed. So 27% of firms think that it will take longer than 3 years to return to the Bank of Canada's 2% inflation target, down from the 32% Q2. Guys, I'm just going to come back in a little bit. I'm just going to be back in about 2 minutes or so. Okay, all right, and I am back. So, as said, we had 27% of firms thinking they'll take longer than 3 years to return to the Bank of Canada's 2% inflation target. And 1/3 of firms expect Canada to be in a recession over the next year, same as in the second quarter. Also, 53% of firms expect inflation to remain above 3% for the next 2 years, down from 64% in Q2. And then more than 70% of firms across the board, across the broad range of sectors, say high interest rates are negatively affecting them. And then also firms anticipate gradual easing in wage growth over the next 12 months. And then going on, so Bank of Canada views, what they say. We rarely get comments from Bank of Canada members, but we had some more this time round. So you had Bank of Canada's Macklem on September the 7th, who said that monetary policy may not be restrictive enough to restore price stability, and that the longer we wait, the harder it is likely to be to reduce inflation. And he also said that it's too early to be thinking about interest rate cuts because they're not there yet. September 19th, you had Bank of Canada's Kozichki, so the volatility in CPI data over the last couple of months is not uncommon, but underlying inflation has seen little recent downward momentum. Then sentiment and views. So on 8th of September, after the employment change data, you had the Canadian money markets that saw a 44% chance of another Bank of Canada rate hike by the year end, up from 36% before the jobs data. On the 19th of September, you had money markets seeing a roughly 40% chance of the Bank of Canada rate hike in October, up from 23% before the CPI report. Then October 13th, money markets saw 34% chance of a rate hike this month, up from 27% earlier on Friday. So overall, there is still the expectation that the central bank will hold rates. All this means is that the speculation that grew over time and then died down over time just shows you how sensitive the markets are to the data points that come through, and how markets try to trade them and then price in and speculate on what the central bank might do in the future. Then if we're looking at some other sentiment reviews as well from investment banks, so over or past, after the day after they had the weaker than expected CPI report the day before, Goldman Sachs weighed in and said that they now expect the Bank of Canada to keep the terminal rate at 5% today. And then JP Morgan also weighed in as well, and they expect the Bank of Canada to hold the terminal rate at 5%. And they remove the previously expected rate hike for October. So remember, if the inflation figures before the one we had recently weren't enough to try and convince the central bank to keep rates where they were, the last CPI report, from what we're seeing here from Goldman Sachs and JP Morgan, should more or less confirm that there is going to be no change for the rate today. Now, any sort of surprises that we get from the Bank of Canada would be, let's say, if they were to keep rates where they were, but say there may be a need to raise rates again in the future, that could cause a bit of an alarm if the central bank has been talking about inflation coming down, but the core inflation not being so strong. So it may be that because of core inflation not coming down as quickly as the central bank would want it to come down, that could be one of the causes for the central bank to then say that we may need to raise rates again in the future if core inflation doesn't come down fast enough. And then if we look at the previous rate decision, how did the markets react from the rates? So if we look at, so this is about so here I'm showing you market reaction 10 seconds before the release comes out, back on September 6th. And then what we'll do is we'll also go through the deviations as well to show you how much of a reaction there was. Overall, So you can see the figure comes out, rate comes in as expected at 5%. The initial market reaction wasn't that strong. It didn't, and also didn't really. You didn't see a dramatic swing to. You didn't see a dramatic decline from the Canadian dollar. A dramatic decline from the markets, or a huge amount of strength, should I say, from the Canadian dollar, off of the back of the data, the figure being released. If I kind of skip ahead, we can kind of see that the dollar CAD had a bit more of a reaction, but compared to some of the other currencies, but looking at the other currency pairs, the reaction again was quite minimal, more or less contained, compared to what we had seen with the dollar CAD, with that data. But if we kind of keep going a bit more forward, and let me see if we can go to the end. Yeah, okay. So there wasn't that much, as you can see there, even after about 15 minutes after the statement and the rate had been released, the market reaction wasn't that strong on the other currency pairs. If I keep going a bit more, maybe we can a bit more. Yeah, after 20 minutes, and then you just get a continuation of what the previous trend of what was going on. That's because, and if we go to the deviations, I'll get out of this video here. That's because if I just bring up the deviation here, bear with me 1 second. Get that set up there. There wasn't anything new or anything shocking to the markets or any surprises. And usually when there are no surprises and the rate comes in as expected, the markets don't really move that much. So if we look at the last Bank of Canada rate decision that we had, you can see here that the market reactions, or the biggest market reaction, was on GBP CAD. Okay, and you see that initially on GBP CAD you had a stronger stronger reaction compared to some of the others, barring the dollar CAD, but the reversal on GBP CAD was quicker compared to the dollar CAD. So you can see here, so this figure here, this first figure, shows you the initial market reaction go to the wick of the candle on a 1 minute chart. And then the figure in brackets shows you the market reaction 10 minutes after the release, going to the end of that candle. And this blue bracketed figure here shows you the market reaction 30 minutes after the release had occurred. So you can see here, more or less very muted within the market compared to some of the other reports, where you can see when there was a surprise rate hike by when there was a surprise rate hike by the central bank, that there was more of a reaction. But here we can see in the sentiment that's listed, very useful to kind of understand what would have moved the market or might not have moved the market that much. The only thing here was we've seen the central bank citing international oil prices being higher than assumed in the July report, but in core inflation is still elevated. And other than that, there was nothing new from the Bank of Canada. So if we do get something similar to this, you could more or less, from historically looking at how the market reacted last time, expect a similar result. Unless you get, as said, comments of the central bank maybe saying that there is a need to raise rates again if oil prices, and if they feel that oil prices are going to have a bigger effect on inflation, rather than just saying that they were higher than assumed. So there's two things that I'm trying to tell you there. So they assume that oil prices are going to be higher, but they would think that it would be temporary, or they say that there is the fear of those higher oil prices then becoming more embedded into the Canadian economy, then in turn making it more difficult for the central bank to bring headline inflation down. And then, of course, the focus will then switch to the core inflation. If they don't feel that could be if they feel that high oil prices are going to be temporary, then the focus is going to shift to the core inflation data. And if they feel that core inflation data isn't coming down as fast as they would want it to be, and they cite that core inflation is still an issue to try and bring down, that could provide some upside momentum to the Canadian dollar instead, if they cite that there is a need to maybe have tighter monetary policy or raise rates again in the future, not at this meeting, or maybe the possibility of raising rates again off of the back of core inflation not coming down as fast as they would want it to be. So that's one risk from the statement. The other risk is, as said, when we're talking about how the currencies react to rate decisions. If they do decide to surprise the market with a 25 basis point hike and take the rate to 5.25% rather than keeping it where it is, then that would be a very big surprise, because the sentiment is that the central bank, off the last inflation print, isn't going to raise rates again, or there's less of a chance of the central bank raising rates. So that's one surprise that could happen if they do decide to raise rates much higher than expected. If they do decide to raise rates when they weren't expected to raise rates, that would provide some upward momentum to the Canadian dollar, unless it's hampered by or tempered by the statement that says that would be the last rate hike that they would do, or they don't need to do any further tightening, and they will just see how the economy performs, and they'll be data-led even more. Hopefully that makes that clear. Michael says, thank you for this presentation. Thank you very much. Haha, my tongue is slipping. Thank you very much for joining me for this presentation. So we've got about 5 minutes left, and what we're going to do is also, if you're looking at this here, I'm going to go through a couple little adverts here and there. But if you found the deviations sheet here, the Google sheet that I'm looking at here, okay, of the deviations, and talking about the economic releases and showing you how much the markets have reacted to economic releases in the past, then what you can do is sign up to the MACROACE mailing list, and you can get this completely free. Okay, you can get this completely free and have access to it when I send out the next email on Monday morning. So you can see, not only you get to see a live up to date version of this here. Okay, so whenever I'm jumping on this and editing it, you can tell. All right, so you could probably, if you wanted to, sit on after this, probably about after 30 minutes or so, you'll see me typing away and adding in sentiment stuff for the Bank of Canada. But you not only can you look at the Bank of Canada, but we've got the Bank of England, the ECB rate decision, which we have tomorrow morning. So I'll be putting a link to that video in the chat later on. We've got the FMC rate decision. You've got a plethora of economic releases that we cover. Some of the economic releases that we have won't have anything covered, because either that they've lost the strength in how strong the market reaction has been compared to how strong it was in the past, or it's something that traders are not really focusing on at the moment, because there are other things that traders would be focused on, such as still inflation, the jobs report, and any other signs of the economy overheating or cooling down. So it's quite, but yeah. So for the central banks, for the interest rate decisions, what we do is we always have the sentiment column, because they're more nuanced. There are things that are said by the central bank that could then flip the market into the other direction. So like I said, you could get a surprise rate hike, but the statement could then dampen that and throw the water on that fire and cause the market and cause the Canadian dollar to go the other way. Instead, you might see a bit of a flash up, and then you could see the market going the other way instead. Again, it's all dependent on what the central bank says, or whether or not traders have slowly been pricing in the expectation for another rate hike, which in this instance they've been doing the opposite. They've been expecting no change in this stance here. So if there is a flip from the central bank to hike by 25 basis points, like I said, you could see some strong upside movement for the Canadian dollar. Historically, from what we've seen in the past, of how when there has been a surprise, you have seen that sort of a strong reaction here. So like here, see that there was 80 pip move towards the downside on the initial candle for GBP CAD. All right, so that's that there. Let's get our chart set up. So we'll look at CAD JPY. We'll look at GBP CAD here. Euro CAD at the bottom. Let's get our TICKSTRIKE up and running here as well. So TICKSTRIKE, if you're unfamiliar with it, or TICKSTRIKE, what it does is it allows you to listen in and look at how strong the order flow is within the markets. Okay, or another way to put it, simpler way to put it, is how strong is the buying or selling momentum. TICKSTRIKE gives you a visual and audible notification of whenever the market is seeing that buying or selling momentum. So we've got about a minute left now. I'll focus on the release, and we'll get through the other stuff later on. Why are rates going crazy right now? Well, yeah. So you have first of all, you have the expectation that central banks are going to probably stick to higher for longer with their rates that they currently have at the moment, rather than cutting rates than what traders previously would have assumed. Okay, so let's see what the Bank of Canada does. Do they want to surprise the market or not? I'm not sure if they are gonna. Okay, 10 seconds. Okay, no change. Rate remains unchanged at 5% as expected. So again, no change from the Bank of Canada. Rate remaining unchanged as expected. Not seeing that much of a reaction, so I'm thinking that the statement itself is not that great either. So weakness from the Canadian dollar off the back of that, not really that much. So let's see what they've said. Okay. It is concerned that progress towards price stability is slow and inflation risks have increased. They're prepared to raise policy rate further if needed. Okay. In addition, to elevated mortgage interest costs, inflation in rent and other housing costs remain high. Let's see. There is growing evidence in Canada that the past rate hikes are dampening economic activity and relieving price pressures. So they're saying that the rates are doing the job for them more than they actually need to raise rates other than themselves. Although they said they're prepared to do that. So again, the key point there would be that there's growing evidence that Canada that past rate hikes are dampening economic activity and relieving price pressures. If we're looking at other areas, revising GDP growth forecast to 1.2% from 1.8% in July. What else? Range of indicators that suggest supply and demand in the economy are now approaching balance. What else? Yeah, there isn't anything new here, to be honest. It's just kind of reiterating that inflation is still high and that the progress towards it has been slower than expected. But as I said, the key point there, what I said earlier, if we can bring it back up. Where are we? Yeah, so okay, I think I might have lost it altogether. No. Yeah, there we go. So yeah, the key point, I said it before, is that past growing evidence in Canada that past rate hikes are dampening economic activity and relieving price pressures. So no surprises in that rate decision there from the Bank of Canada. And as said, did see a little bit of that, well, did see some of that weakness in the Canadian dollar. If we do a little measurement then on the what we've seen as the biggest move last time around, which was GBP CAD, let's have a little look. See what we would have got there. Okay, yes, it's about 15 pips towards the upside. So again, not an outstanding or surprising not surprising statement, or nothing, no surprises within the statement, should I say. EuroCAD. Yeah, 11.5 pips towards the upside. CAD JPY, let's take a look. Which has usually had the strongest market reaction in the past. Okay. Well, not today. It's about 9 pips down. So a very boring release there from the Bank of Canada. Again, nothing out of the blue, no big surprises. And yeah, that's basically it. So let's talk about some other stuff then. Well, first of all, don't forget, if you like this video so far, to share it, subscribe to the channel, get the word out there. And yeah, so let's talk about FinancialJuice. So FinancialJuice is a live voice and text service that keeps you up to date with what's going on in the not only the markets but globally as well. So with the Israel-Hamas conflict that we've seen, maybe there's a comment by the Bank of Japan talking about maybe not needing to change or make any changes to their monetary policy in the immediate future, which led to the yen weakening by quite a bit, particularly against the US dollar. Those comments like that, those surprises that creep in into the market that you might not be aware of, that's very important to understand and to stay in the know about. Because if you don't stay in the know about what's going on in the markets, okay, fine, fair enough. You can trade the markets how you want, but knowing why the markets are moving in a certain way, it gives you the extra authority and the extra that gives you the extra tool to then be able to capitalize on potential trades. Because let's say if the Bank of Japan does say one thing where they might be thinking about they're tweaking the yield curve control, but there's no need for an immediate change. At that point, when I was looking at it on the dollar yen, actually, if I bring it up here, let me see if I can get it. Okay. Right. There we go. Okay, so at that point here, on the market reaction, what we'd seen, so you'd seen that a little bit of whipsawing here and there off of the back of that news. Now, you might not know why the market whipsawed, but if you looked at the headline, there were two things that were being said there: that they're mulling a tweak to the yield curve control because of US yields, but that you see little need to change forward guidance. So those two things impacted the market at that time. So initially you'd seen that whipsawing. You'd want to know what's been said. Why did the market see a whipsaw, and why is now the yen seeing further weakness, particularly against the dollar? Well, there you go. It's there. That's the key thing that moved the market at that time within the European session. There can be market moves at any time, right? Because of what's been said with what's been said by a certain someone. Maybe an event has occurred, or maybe there has been an economic release data that has rocked the markets. It's important to kind of understand that, and if you have a basic understanding of the fundamental side of things, then again, as said, that's another tool to add to your arsenal. So again, FinancialJuice is a live voice and text service that provides you up-to-date news in real time all in one place. So you have your, you can probably see this with my mouse, but you have the live voice feed here, which plays our guy, so James, who read the rate decision. You'll hear him on the microphone calling out the headlines and the figure. And here in the center, you have the headlines as well. Again, also in live and real time as well. On the left-hand side, you have your economic calendar, or the upcoming economic releases that you have, or the past releases for that day, all in one place. And this is also in live and real time as well. So that's the key thing. As a day trader, you'd want to be able to capitalize on any opportunity that you find within the markets. And the service we provide, there may be the opportunity that is then presented to you to capitalize on or make off yourself. So that's the key thing as a day trader, is you want to be able to capitalize on those opportunities, no matter where it is. As long as, it's market moving news, that's what you're more or less focused on in your day trading. So that's what FinancialJuice is made for the day traders, to be able to keep up to date and stay in the know with what's going on in the markets, and then capitalize on those potential opportunities. So there's a 7-day free trial to if you want to sign up to FinancialJuice, you can jump on here. That's there, FinancialJuice.com. Set up a free account if you've never come across a live voice and text service. Make sure you go to your email and verify your account for the email that's sent. If you want to go to the pro version straight away, first have an account on FinancialJuice, which will be the light version. The light version has adverts that play, and there is a delay to the feed. But if you do want to go to the pro version, if you feel like, I want to do that, then there'll be a button that'll be around here in the where it says FinancialJuice Pro. It'll say Go Pro. Click on that, select your subscription, pay for the sub, log out, then log back into your account, and then you should have the pro version of FinancialJuice. Level Louis says, what is MACROACE worth signing up for? So as said, with MACROACE, you have the deviations for the economic releases, okay, to show you how big the market reactions have been. What has the market reaction been like to economic releases? Let me bring it up again, if you weren't able to see it earlier on. So here we go. So here we go. This is all the data for how the markets have reacted to different economic releases. As said, there will be, so here you can see that you have the initial market reaction highlighted here on the initial candle, the 1 minute candle, and then in the figure in brackets shows you the market reaction 10 minutes after the release, going to the end of the candle, and the same with the 30-minute market reaction as well here in the blue brackets. You can, from that, decipher what you might want to do with your trade, depending on what the figure is, what the deviation is, and you have a historical reference of that there as well. So again, with the PC data, again, it's also not as big of a mover as it was beforehand, but you can see in the past that you'd had different deviations, and you can kind of that's what it's there for. Shows you how big the market reaction was. Then you can kind of make your own decision on what kind of deviation you're looking for to then make a trade or no trade. So that's one part of MACROACE. The other part of MACROACE is you also get an email on the Monday as well that gives you a short breakdown of what to expect for the week ahead in Europe, US, and the Asia session. It's a short email. It's not filled with graphs or charts or anything like that, because it's nice to have a quick refresher of what to expect. And you also get the link to the live streams as well, to be able to see to see the streams here. Again, this is all free, right? So you can have a little play with it. If it's something that's not free, fine, doesn't cost you anything. If you really enjoy it, fine, it's still free. That's the whole point, is to make this useful information that's accessible to day traders, and then for you guys to use it however you want to use it. So hopefully that answers your question there. And then TICKSTRIKE. So TICKSTRIKE, what it does is, as said, it allows you to listen in to and get visual and audible alerts for how strong the buying or selling momentum is. Okay, how strong is the order flow? Okay, so this ticker here is GBP CAD, And this plus symbol shows you the buying momentum, and of course the minus symbol will show you the selling momentum. So here we can see that there is a number which is 3. So this is actually, that number comes from here, the slider, or the sensitivity level. 1 is the most sensitive to market reactions. So when there is a bit of buying or selling momentum that occurs, if I just drag that here, you can see that again here, showing with GP CAD and the ticker here, then TICKSTRIKE will pop off and give you that visual or audio load, or both. And then as you increase that level on this slider here from 1 all the way to 15, 15 is the least sensitive to market reactions. So only when there's a big amount of buying or selling momentum that is occurring, then only then will TICKSTRIKE give you a visual and audible alert, or whichever one, or if you decide to do it that way. So that's what TICKSTRIKE is there for. Again, it's a tool for day traders to be able to capitalize on the market moves that are occurring, or to manage their risk, and kind of see how strong is a buying or selling momentum within stocks, currencies, FX, futures, your internals like your ADD or your VIX, and also ETFs as well. Did I say crypto? And yeah, and crypto as well. Okay, so there's a multitude of different areas you can look at with TICKSTRIKE. This symbol here, lightning symbol, if that's your question, your next question. So this lightning symbol represents 15 levels below 1. So remember, 1 is the most sensitive to market reactions. So particularly if you're scalping the markets, right? If you go to 1 on here, it's uber sensitive to the market, right? Much more than the level 1 is without the lightning bolt on. So again, capitalizing on those moves here and there within the markets, if you're looking to scalp the markets or jump onto those little bits, take those little bits of profits here and there. Again, if you're not familiar with what TICKSTRIKE is, on the FinancialJuice page, on the newsfeed here, you do have a free version of TICKSTRIKE, but you can only look at the S&P 500, Euro Dollar, oil, and Bitcoin, and the sensitivity level is stuck. So you can't really move around it or play around with it. But if it's, let's say, if you're getting used to what TICKSTRIKE is, then you can use the version on the site, and then when you're ready, you can go to the full version of TICKSTRIKE here. Okay, there we go. There you go. So yeah, so as said, if you're unfamiliar with what TICKSTRIKE is, have a little play with it first on the newsfeed that we have on the FinancialJuice newsfeed, and then when you're ready, you can have a 7-day free trial of the full version, and then choose whatever you want to do from there. Okay, ladies and gentlemen, thank you very much for joining me live for MACROACE. Tomorrow we have the ECB rate decision, so let me get that video for you here. Let me just grab that. All right, let's see. As said, don't forget to like and subscribe to our channel as well if you found the information useful. So here we go. This is the live stream for tomorrow. Okay, and that will be at 7:45 a.m. Eastern time, so about 30 minutes before the ECB rate decision at 8:15 a.m. Eastern time. Okay, ladies and gentlemen, thank you very much. Enjoy the rest of your day, and I will see you guys tomorrow. Goodbye.